Hey y'all, welcome to the channel. Today we're going to be talking about the three different types of markets, that being frontier, developed, and emerging markets that are used to determine the type of market in each country. This can be used for a variety of things and is used to judge a lot of factors when it comes to making an economy. Before we get started, I just want to clarify this is not financial advice. The opinions expressed here are solely my own and are for educational and entertainment purposes only. Investing involves risk. Past performance is not a guarantee of future performance. Do your own research, please. With that being said, we're going to start talking about the first market we have today, which are developed markets, which are the largest of the three. Firstly, developed markets are characterized by having a high GDP per capita. So, what does the average person make of the country is high. This could mean a large consumer base. Basically, just people have a lot of money to spend on consumer goods. So there's a lot of people to sell to, and it's easy to find business in this country. Another characteristic could be politically stable. Not a lot of regime changes. Excuse me. Not a lot of civil wars. There's no major political shifts that would affect the economy or the economic situation or how the government treats the economy. It's generally predictable, and it stays the same. Another one, technologically advanced. They have access to technology, and this one kind of aligns to another one, which is developed infrastructure. Uh, Maybe they have ports, roads. They have financial services. In general, the infrastructure of the country is solid and can support a large base of people or businesses. Especially with things like ports or roads, it's important when it comes to logistics. So, a developed market uh, has a lot of good infrastructure, maybe also like Wi-Fi as well. So it's easy for connection with people outside of the country or markets. Another one is high liquidity. It's easy to buy and sell. There's maybe pre-existing financial institutions, so it's easier to trade. You can invest a lot and get out quickly. There's less hoops to jump through. It's just a generally easier experience. And then the last one would be stable currency. This one kind of aligns with the politically stable, but there may be inflation, but in general, there's no price hikes, hyperinflation. It's generally stable, or at least the trend is pretty trackable. So it's easier to predict. There's a lesser risk of you waking up tomorrow and the currency is drastically different. So that, which obviously currency is useful in a numerous amounts of things when it comes to trading, investing. So stable currency is a pretty integral part of an economy. So that's a big green flag. When it comes to general examples of developed market and countries you should think Western Europe, or all the countries in Western Europe, the United States, Canada, Japan, South Korea. Obviously, highly technologically advanced societies, a lot of infrastructure, a lot of people, a lot of money. Uh, those are often considered the most textbook developed markets. With that, the second type of market that we're going to talk about today are emerging markets. Markets are typically markets that are on the way to becoming developed markets, but they're not quite there yet. They can usually be characterized by having a high level of economic or industrial growth. Uh, they usually have a moderate GDP level, not as high as a developed market, but not as low as a frontier market. They're usually developing financial institutions. They're not as liquid as a developed market, but they're getting there. Usually, maybe they have a stock exchange. It really depends. But there's starting to be a more widespread financial institutions, more financial liquidity on the similar levels to a developed market. And also, they're typically less stable or lesser stable than developed markets, maybe in currency or in government wise, economics. Uh, they're kind of just in general at the halfway point between a frontier market and a developed market. They are characterized by more riskier than developed markets, but also having higher growth potential due to the fact that they're still developing and as a nation, and you're kind of getting in closer to the ground floor, if that makes sense. Lastly, we have frontier markets. These are the smallest of the three and can be characterized by being much more less liquid. They're less financially developed. They don't have as many institutions. They have less infrastructure in general when it comes to roads, highways, ports. They're just less developed usually. They have a lower GDP per capita, which just in general means like a smaller consumer base or less like wealthy. So it's harder to sell maybe more expensive products or more bulk products, or just in general, it's harder to sell a large amount of products. They're typically higher risk. These are companies. Sorry, these are countries on the cusp of developing, so they're you're getting in at the ground floor. So obviously, there's a lot of risk. There's a lot of unforeseen political events, anything, and that kind of ties into the next one, which is politically and economically more unstable, harder to predict. That kind of just comes with the fact that these are countries again just starting development. But in general, these are some. They could be great investment opportunities, but obviously they come with their risk as any great opportunity. Uh, and some examples you could probably think of are countries like Mexico, Kenya, Vietnam. In general, it's just useful to know what type of market you're investing into in order to calculate risk, return, all those metrics, factors that you probably want to know before getting into an investment. But with all that being said, thank you so much for watching this video. I hope you enjoyed. And again, if I made any mistakes, please feel free to correct me in the comments. Thank you so much.